Talking about that all day yesterday.
24 seconds away from the opening bell in New York City this morning. Good morning. Here's the price action. A snap back yesterday and then a snap lower again. Down 0.6 on the S&P. On the Nasdaq 100, about 17% of the index reporting later in just two names. We'll hear from Alphabet and Microsoft too. We are negative there by 0.7%. There's the opening bell. Switch up the board and get to the bond market for a third straight session. Yields heading lower by a chunky 8 basis points to 274.34. The euro negative, a weaker euro, 106.82. A 106 handle. Remember the lows of late 2016, early 2017, a 103 handle. We're getting there. I would argue that back then, that was a goal of the ECB to get a weaker euro. I'd argue this time, that complicates things with inflation creeping ever higher. We're negative there, a third of 1%. And crude back to 100 on WTI, up by 1.55%. That's the cross-asset price action. We're just a little bit softer, lower negative in the early part of today. Let's get you some movers. Here's Candy Lyons.
Well, and it is a big earnings day as well, John. A lot of those movers at play here, and a lot of them tying back to the inflation and higher prices story. There are some beneficiaries of that, specifically those companies tied to the commodities and raw material space, including Archer's Daniels Midland, which of course is one of the world's biggest agricultural traders and processors. It handily beat expectations and announced its most profitable quarter ever, helped by strained supplies within the agriculture market due to drought, war in Ukraine. It's up 5.5% at the opening bell. Then on the oil side, you have Valero reported basically double the refining margins from a year ago, highest level since 2015. That stock is up about 0.9%. But companies face headwinds from higher prices as well. Whirlpool is one example. Those inflationary forces leading to a cut for both its earnings and revenue outlook. However, there is some optimism in the stock today, up nearly 5% on a strategic review of its EMEA business. And finally, Universal Health Services. This is an issue with higher labor costs. That led to an earnings miss, the stock getting punished as a result, down nearly 11% at the opening bell, John.
Kelly Lyons, thank you. One more stock to watch, of course, is Twitter, negative about 0.7%, trading in and around 51.30. Looking at this, of course, on the West Coast, Ed Ludlow. Morning, Ed.
Good morning, John. Elon Musk has his deal to buy Twitter and take the company private for $44 billion. He'll give an investor $54.20 for each share that they hold. Transaction to close by the end of this year, unanimously backed by Twitter's board. Last night in an all-hands, Twitter's chairman, Bret Taylor, told employees, according to sources, that he'd done his fiduciary duty. $54.20 per share in cash. If you were an early investor in Twitter, you bought on the opening day of trading, October 2013, where the stock opened around $45, you're looking at a compound annual growth rate of around 2%. In other words, you made about $9 a share over the last 9 years or so. Not much to go off, right, if you've been holding the stock for that long. Then you look at the financing, $25.5 billion of debt confirmed in the statement, $12.5 billion in the form of a margin loan. The big remaining question is the $21 billion portion that's in equity financing. The Musk mystery, where does he get the cash? Now this is more friendly as opposed to a hostile takeover. Could we see private equity come in? Musk has talked about wanting to retain as many of the existing shareholders as he can. Could he roll some of those shares into the private entity? Or perhaps he sells down some of his Tesla stake or even some of his crypto holdings. Those are the kind of theories on the table, John, of how we move forward. But ultimately, the statement said that the deal was between Twitter and an entity wholly owned by Musk, no co-investors on the equity portion of that financing.
Ed, what have we learned about breakup fees and the sort?
Yeah, so exactly. If Elon Musk walks away, according to sources, he will have to pay Twitter a breakup fee. We don't know what the amount is that's agreed in certain terms of that fee. The other thing is that there is not a go shop clause, right? Twitter cannot solicit bids from other bidders while this process is going on, while the transaction's pending close before the end of the year.
Ed Ludlow, thank you, buddy, as always. Dan Ives has this to say over at Wedbush. It all came down to no other bidders or white knights emerging in the M&A process, and Twitter's board back was against the wall. Once Musk detailed his $46 billion in financing last week to get pen to paper on this deal. Dan joins us now. If the team in the control room could just bring up the financing again of this particular deal, and you and I can go through some of the numbers together. And Elon Musk on the equity side of things, where's this cash coming from? Dan, have you got a decent read on this, that $21 billion in cash that needs to be raised?
Yeah, so that 21 billion, like you and Ed talked about, I mean, some of it could come from private equity or brings a partner in. Otherwise, that would be Tesla shares. Now, if you go back to that, that would be roughly about 12-15% of his ownership of Tesla. But importantly, those shares are not sold. Those shares are basically collateralized for a certain time period. Some portion could eventually be sold. But ultimately, this is really him, like we talked about, it's trading a portion of his Tesla shares to buy Twitter. And of course, the collateralized loan piece as well.
That piece you're comfortable with. Now walk me through the loans. Have we got a good idea of the interest on those loans, Dan? And if so, what are they?
Yeah, so I think that still needs to come out in terms of the interest there. And obviously, look, these are going to be, significant collateralized in terms of what he's ultimately offering from a stock perspective, because that's really what he's doing. I mean, he's leveraging his stock in Tesla to buy Twitter. And I think it's one where it's viewed as a contained risk in the eyes of Tesla holders. I think more of the worry is just if there's a distraction. I think that's sort of overdone here. But I think this all needs to sort of play out in terms of just more details on the financing piece, specifically the equity financing, because that's the biggest worry in terms of could that be another sluggish stock.
Well, Dan, if it can close, how it's structured, I think is critical to how it operates, because a lot of people are talking about whether this is going to be a for-profit business or a multi-billion-dollar moral crusade. If we're going to have high interest payments on some of these loans, he's going to struggle to make it the latter, isn't he?
Look, I mean, the whole issue here is he'll be able to pay for it, right? I mean, in terms of he's pledging about 20% of his net worth for Twitter. But it just comes down to the easy part in all context was buying Twitter. The hard part's going to be fixing it, because that's the whole issue. That's why no other white knight came, because anyone that looked at this from a PE or strategic, 54.20, I mean, you have to be drinking a lot of Cabernet or alcohol to pay that. And I think that was the whole issue. That's why ultimately, talk about Taylor and the board. Yeah. Once another white knight didn't come, he laid out the finance and they had to get to the table.
Dan, what is the $4 a doubt in the price tally right now? In fact, it's a little bit less than that. 50.75 in early trading, 54.20 the offer. What do you make of that spread at the moment?
And that's regulatory, not necessarily antitrust, but this will get pretty close looks within the Beltway as well as Brussels. It's must, so it's always a lightning rod situation. Of course, Twitter, look, it's a tightrope for him, and this is not just any platform. It's definitely going to get more scrutiny. We ultimately believe it does close, but there's still some twists and turns ahead, and I think that's what you're seeing the ARBs play here. That more than the financing is what they're playing.
We know there's some very sensitive people in the C-suite that if we see less censorship on a platform like this one, they're going to be increasingly uncomfortable with advertising on it. Michael Nathanson of MoffettNathanson said this: advertisers will be less willing to spend on Twitter if Elon Musk removes content moderation in order to promote free speech. Is that just going to, Dan, push them even further into a subscription model? And when you sit down with a team, have you modeled what a subscription model would look like? How many users would hang around? How many people would actually pay it?
Yeah, so Nathanson, what he's talking about, that's exactly true. And I think that's something they'll move more to a subscription model, probably $2 to $3 per month. If you even assume they got a third of their subs became paid, assuming there was power users, I mean, revenue could go up 20%, and you'd have a lot more free cash flow subscription. But again, easier on paper than actuality, because in this social media arms race, Twitter, as Ed talked about, the last decade, it's been a treadmill stock.
You've talked about how this might invite some scrutiny on Tesla, and that's the stock that falls under your coverage, Dan. Jeff Bezos out on Twitter yesterday evening said this: interesting question. Did the Chinese government just gain
firestorm? Look, I mean, this is going to be a tightrope, because on both sides of the aisle, not just in the U.S., but globally, then you look at Tesla, obviously the relationship in China, globally. Could there be a blowback? Could there be a blowback to SpaceX? I think it's calculated when he went after Twitter. That's not what you want to see, because it invites just this sort of Category 5 storm in terms of a tornado that ultimately is going to come with owning Twitter.
You're one of the big bulls on the street on that name, though, of 1,400, your price target. Dan, is there anything in this that makes you question that 1,400? Anything at all?
For now, no, because I ultimately, it's a contained distraction. I think Musk's really sole focus continues to be Tesla. And we don't worry about that. It's the fundamental story. But any tripping over the shoelace, any stumble will clearly be magnified in terms of is he taking the eye off the ball. And that's something that really comes to the territory over the next 6, 9, 12 to 18 months when you're trying to turn around Twitter, which is going to be a Kilimanjaro-like climb.
Dan, final word, buddy. A little bit later, we'll hear from Microsoft and Alphabet. If you had to pick one, which one do you like the most right now?
Microsoft Cloud, that continues to be robust in terms of digital transformation. Microsoft's the cloud behemoth. I think that continues to steer tech higher.
Both those names have had a terrible month through April. Dan Ives, thank you, buddy, as always, from Wedbush. On Twitter, on the earnings coming up a little bit later. Coming up on this program, European banks getting a boost from tighter central bank policy.
The markets, that was a really good quarter, as you know, a record quarter. It's just that the equity capital markets side dried up because of the uncertainty in the markets.
They are hoping for rate hikes from the ECB across Europe. That conversation up next.
We are quite optimistic even, beyond 22, 23, 24 on the back of these much higher rates.
We've said that we want to get back to double-digit returns next year. We're very confident in getting back there. We're very optimistic about the outlook over the next 12 to 18 months.
The biggest second-round effect will continue to be a pressure on commodity prices, which may cause a further need for central banks to curb that inflation.
European banks hoping for something that we haven't seen in more than a decade from the ECB, a rate hike. The UBS CEO Ralph Hamers saying the following: rising rates will absolutely help our net interest income. Will they get it anytime soon? Taking a look, here's Taylor Riggs.
And John, at least from the UBS perspective, things looking a little bit better than expected, coming in on some higher trading revenue, at least given perhaps some of the uncertainty and the volatility from Russia's war in Ukraine. So UBS, of course, on the trading side, benefiting from that. Santander is, though, a different story. Citi analysts coming out and saying that this stock is not an automatic buy rating. They've no capital improvements for the year, and there's still a lot of concerns about the economic weakness in Europe. HSBC also a similar story in saying that more buybacks are actually unlikely. They had a 25% drop in adjusted pre-tax profit. But that switches here to the U.S., which is actually a little bit of a different story, but still a big focus here on supply chains. 3M caught off guard by higher expenses. GE looking at supply chain issues. Raytheon cutting the forecast. Polaris, of course, blaming all that first quarter weakness on supply chain issues. If you don't hear the theme in my voice, John, then I could repeat supply chain one more time. Finally, though, of course, what this means is when we think about expenses, how it impacts the bottom line. I know that all the work out of BI, Gina Martin Adams, has done a lot of work on some of that top line revenue, but can these companies pass those costs down to the bottom line? This is where that operating margin, some concerns here of peaking, how you sort of keep up, maybe even expand some of those operating margins in this environment.
Taylor Riggs, looking forward to your coverage a little bit later after the close of Big Tech reporting earnings. A little bit later after the close, we hear from Alphabet and Microsoft, tomorrow Facebook, then on to Thursday, Amazon and Apple. As we said a little bit earlier in this program, those 5 names responsible for 40% of the weighting on the NASDAQ 100. The NASDAQ 100 this year to date, has struggled month to date, struggled in a big way as well. In Europe, things get weird for the banks in Europe. If I told you year to date that we'd have a move of 70, 75 basis points at the front end of the German curve, would you say the financials, the banks on the Stock 600 would be down by more than 9%? That's the story. And that's the struggle in the FX market as well. We're looking at central banks hike interest rates with a really, really tough inflation backdrop against a softer growth backdrop. And for that reason, what you're seeing is the banks trade lower in Europe, the currency struggle, and you see a similar story over in the UK as well with that sterling weakness coming through, that clean break of 130 on cable. Joining us now, Emily Hill of Marisol Capital Advisors. She joins us on the equity story through the day ahead. Emily, I want to start with your big theme, and that's slowing growth and more prolonged inflation. How does that shape up your outlook?
Well, as I think I mentioned to you before, I think there have been a very powerful force that has been keeping a lid on inflation for the last several decades. And the primary one, or one of the primary ones, has been globalization. And what we've seen over the last year, and it's accelerated, in the last 3 months, has been an unraveling of globalization. And so we're going to end up with a situation where, every nation needs their own source of supply. We've seen very fractured, very stressed supply chains. And so that deglobalization is inflationary. So that is, I think it's going to make it more difficult for the Fed to bring inflation under control than they might be anticipating. I think they're anticipating a challenge as it is.
Deutsche Bank came out with some pretty strong words earlier today, Emily. I'd love your reaction to it. They said there are good reasons to expect inflation will continue to surprise to the upside. We regard it, therefore, as highly likely that the Fed will have to step on the brakes even more firmly, and a deeper recession will be needed to bring inflation to heel. Emily, do you agree with that?
I do agree with that. I think the Fed is in a situation where they've got inflation over 5% and they've got unemployment under 4%. And if you look at the last 8 times that happened, there's been a recession each time. Now, there are some differences in the current environment, but, I think the Fed is going to have to move aggressively. And I'm obviously not alone in that assumption.
So slower growth, more prolonged inflation, a more aggressive Federal Reserve, the trends that you identify exacerbated by the deglobalization we've seen going into the pandemic and coming out of the pandemic much more so. As you look across those big themes, Emily, what are the companies best positioned to capitalize on those trends?
In a stagflationary environment, your best bet is defensive companies with pricing power. So we like global infrastructure. We like companies like Honeywell, which is, while it's an industrial, is very high quality, has a good balance sheet, has potential to grow due to its focus on ESG, potentials in quantum computing, et cetera. So you want a company that is again defensive and has the ability to raise prices in an inflationary environment.
Given everything you've described, how do you think the bond market's going to perform? If this is going to be the status quo for a while, Emily, what do you think that looks like on the other side of the portfolio? We've been used to decades coming into this particular crisis of inflation remaining low and the bond market in a bull market. And in that environment, it's made sense to have this ballast in the portfolio, and that ballast has been fixed income, Emily. Has that changed at all?
Fixed income has had a terrible 12 months. I mean, this has been one of the worst years for fixed income in 10 years. Look what's happened to U.S. Treasuries. So we have been underweight bonds now for about a year and a half, if not 2 years. And the problem is the interest rates were so close to the lower bound that it was very difficult for bonds to play their traditional role in portfolios, which is lack of correlation and ballast. So while I certainly am not expecting to cut a fat hog on bonds over the next 2 years, I do think that they're going to return to playing their traditional role in portfolios. And so we have been buying bonds again, beginning very recently. And I think it's going to be important given the volatility that we expect over the next 3 to 6 months at least in global stock markets.
Interesting. Emily Hill, thank you. Thank you very much. On a day where this bond market is rallying and rallying hard, yields are lower, much lower, and the banks are struggling. The banks on the S&P 500 down about a percentage point. So this is a fourth straight day of weakness for the banks on the S&P 500, and a big move on the front end in a quiet period for the Federal Reserve. If you think about the high of the last year on a 2-year, the high was 278.48, and you look at where we're trading right now at 252.13. That was an intraday high, by the way, on a 2-year. Yields are in about 10-11 basis points at the front end on a 2-year and on a 3-year. On a 10-year right now, down 8 basis points. For a third straight session, the Treasury market is rallying. We're down 8 basis points to 174. And all of this going into the Federal Reserve meeting a week tomorrow, looking for a 50 basis point move from this Federal Reserve. The quest is to get back to neutral, whatever the Fed thinks neutral is. And the debate that Wall Street is having is how much further beyond neutral is this Federal Reserve willing to go? How much further beyond neutral does this Fed need to go to help get inflation back down? And when we say get back down, are we talking about getting back down to 2 or getting comfortable with something in and around 3? Or maybe even 4. From New York, coming up, the trading diary, your guide into the weekend, and just a massive 3 days for earnings for this NASDAQ 100 and the S&P. Big tech reporting, those reports just around the corner. 25 minutes into the session, some real old school risk aversion here. Equities heading lower, down 1% on the S&P, wiping out the gains of yesterday on the Nasdaq 100. We're down 1.8%. Big day of earnings coming up. The yen is stronger. The Treasury market's rallying. 2s, 10s and 30s. Yields lower, much lower, down 10 basis points at the front end to 252.55. That's a ball steepener there. That's interesting. That's the price action. Here's the trading diary. Big tech, those results coming after the close. Microsoft and Alphabet, then Facebook on Wednesday, Apple, Amazon and Twitter on Thursday. We get a Bank of Japan rate decision a little bit later this week, another round of initial jobless claims and Q1 GDP, and finally rounding out the week with a read of consumption and wages coming up a little bit later this week. From New York City, for our audience worldwide, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Tuesday, April 26th. Here are the top market stories we are following for you at this hour. 'Tis the season. Earnings fly thick and fast, but fail to give a boost to U.S. stocks. Big tech next on deck with Alphabet and Microsoft due after the bell. Now what? Elon Musk has struck a $44 billion deal to buy Twitter, but how does he come up with the $21 billion he's personally guaranteed? Who will run the company? And what will regulators think? And Economic Insights consumer confidence data just crossing the wire as questions swirl around the growth outlook. We'll get the read from Steven Steinort, Huntington Bancshares CEO. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. And Guy, we've had earnings crossing the wire all day long. Now economic data crossing the wire as well.
Actually, I think the earnings story is much more of a macro event this time round than many people give it credit for. But let's talk about, as you say, the macro data we're actually getting. We're getting the consumer confidence data from the Conference Board, 107.3. Now, that's actually up from 107.2 last time around, which I think is interesting. But the economists had expected that number to tick a little bit higher to 108.2. The present situation comes through a little softer than last time. I just want to check what the revision looks like on that data versus last time as well. So the present situation data revised up to 153.8. This data 152.6. So a little bit of a softening there. We're also getting housing data, which looks broadly in line with expectations, but a little bit of a softening in those numbers too. Kelly, I think this basically is a really interesting story. We've got an earnings report which is so far telling us that the consumer is in quite good shape. That seems to be the message that we're getting, and it's going to be really interesting, as you say, to talk to the banking industry throughout this program to get a sense of what is happening more broadly in terms of the loan demand and what consumers are saying. But I think broadly the earnings season is telling us that the consumer is in really good shape right now. The data is holding up, I think, and that's the big kind of macro takeaway for me from this earnings season, aside, of course, from the fact that it's inflation.
Yeah, it absolutely is inflation, which to your point about the consumer, Guy, in order for companies to deal with inflation, they have to be able to exercise pricing power and pass on higher costs. Having mixed success in doing so, I will say, at least when you look at the reports from today, from those that reported before the bell, the likes of UPS, for example, they actually are having success on the pricing power front. They are raising prices. That led to a profit beat. A little bit of concern on volume, however, which is why the shares are down. Whirlpool had to cut both its sales and earnings forecast due to higher inflationary forces. The only reason that stock is higher is because of a strategic review of its EMEA business. GE had said that its profit for the year will be likely at the lower end of the range due to inflationary headwinds. We can see that stock is down about 9%. Pepsi was warning about higher than expected cost inflation as well. Really, inflation, as Guy says, is the name of the game. And this really brings us to our question of the day. Inflation, of course, a big macroeconomic picture. So how much does the micro, how much do earnings matter in a macro market? Let's ask Cameron Dawson, FieldPoint Private Chief Market Strategist, and Gina Martin-Adams, our Chief Equity Strategist here at Bloomberg Intelligence. Cameron, I'll come to you first. Do earnings really matter?
Oh, they matter so much right now because we cannot count on higher multiples to drive upside in this market. With the Fed tightening, we do expect multiples to continue to compress, and they still remain above long-term averages at about 18.5 times. Every time the Fed tightens, multiples come down, and they usually go down below average. So that means that the onus is on earnings growth to drive upside in this market. And the challenge we see is that we still see some pretty aggressive assumptions on the margin line for earnings for this year. Earnings or margins are expected to go to a record high of 17% by the end of this year. And we think that could be a challenge in a world where costs remain elevated, but demand is starting to slow, which calls into question how strong pricing power can continue to be. So margins are the things to watch for earnings.
Have you two been comparing notes? Because I feel this is exactly what Gina's going to be saying as well.
Yeah, I think it's a very similar story for us. Look, on the multiple point, well, we just think about where we were a month ago. The market was anticipating the 2-year Treasury yield to rise to just under 2% over the course of the next 12 months. That, in our model, implies that you should be paying about 17 times forward earnings for stocks. Well, lo and behold, the 2-year has risen much faster than anticipated. The market's now expecting closer to 3% on that 2-year Treasury yield, which implies that you should be paying closer to 14 times earnings for stocks. So what's happening in the market is really largely reflecting what's happening with Fed policy. On the earnings front, I entirely agree with Cameron. As a matter of fact, our research would show that earnings are more important for driving stock prices during periods of macroeconomic distress or macroeconomic uncertainty. They are also more important for driving stock prices during periods of Fed tightening or a lack of Fed easing, as has been more the case over the last decade. So earnings are very important. And completely agree, the most important thing to watch is the margin line. We're now looking at 7 of the 11 S&P 500 sectors posting margin contraction on a year-over-year basis so far this earnings season.
Well, Gina, you talk about earnings driving the market, and obviously earnings from some players have a lot more influence in the equity market than others. I'm thinking just this week, 5 big tech companies reporting comprising $8.5 trillion in market capitalization. How much can big tech move the needle, and in what direction do you think that needle will move?
Yeah, they can move the needle entirely. I think we saw that with Netflix just a few days ago, right? Big tech is incredibly important, not just big tech, but big communication stocks. So you've got 2 sectors really encapsulating the biggest of the mega cap companies in the S&P 500, along with the discretionary sector. Don't forget, Amazon and Tesla are discretionary companies, even though we all think of them as big tech. So you've got these sort of 3 segments in the market that are incredibly important. I think the thing that matters most, frankly, is the fact that interest rates are rising for this segment. Earnings are very important, and earnings need to beat, and guidance needs to come in incredibly optimistic to justify valuations in an environment where interest rates are moving higher. This is a group, if you just take the top 5 mega cap stocks in the S&P 500, this group is trading at a 50% premium on a PE basis relative to the rest of the index. Our work suggests, just based on earnings alone and the earnings trends that we're likely to experience over the next 2 years, that premium should contract to 20%, relative to the rest of the market. So that's a pretty big valuation compression that we should see for these stocks. They've got to beat and they've got to raise in order for the market to hold up in the environment of that kind of multiple compression.
Cameron, why can't they do that? Many of these businesses are in areas that structurally look very good. We are seeing a secular shift, if I can get the words out, towards the cloud. That's going to benefit businesses like Amazon. It's going to benefit businesses like Microsoft. Why can't these businesses deliver the kinds of outperformance that maybe is possible here?
I think the big question is how much pull forward that we saw into 2020 and 2021, given the big shift to cloud that really brought forward years of growth into those years. And the question is, what is the deceleration in the growth rates because of that pull forward? But even if earnings do come in better, I still think that there is risk to the multiples for tech overall. Tech still trades at a 20% premium to the market in its entirety. And the thing is, prior to 2019, tech traded at a discount to the market. It's wild to think because we think of these companies as being better free cash flow, better return on invested capital names. They deserve a premium. But prior to the Fed moving to ease policy aggressively in 2019, when real rates started to roll over and eventually moved deeply negative, tech traded at that discount. It got all the way up to a premium of 30% back last year, but it's still at a 20% premium. We think that that premium has room to fall as the tech continues to be tighter.
All right, Cameron, so that's one area of the market. Let's talk about some others, like the ones in which GE is a dominant player. What are your thoughts on the results we saw out of GE today, the inflationary forces that it's facing, and how that's emblematic of the broader basket of stocks with which you would include GE and how they are going to fare in this environment?
Yeah, this was yet another messy quarter for GE. So it appeared to beat on EPS numbers versus consensus, but it's important to remember that consensus numbers had already been cut by 60% as we moved through the year. And it really was the issues that GE had with inflationary pressures and the lack of ability to be able to pass on those cost increases onto their customers. They talked in the renewables business about their customers actually delaying purchases because prices had had simply become too high. So we really struggle to think, as we are in this late cycle environment, why investors would want to own a name like GE. When you are late cycle, you want quality, you want strong free cash flow, you want strong balance sheets, you want strong pricing power, and GE frankly doesn't have any of those things. It still has some of the highest leverage versus its peers. Its free cash flow generation continues to be much lower than its net income, which means earnings quality is weak. And we had that pricing issue this quarter where they're not able to pass on inflation. So we think in a late cycle environment, you have to focus on those names that have quality, and frankly, GE just isn't one of them.
Gina, Cameron talks about us being late cycle, and certainly all evidence would point us in that direction. Yet I listened to some of the notes coming out of some of the calls from companies that are reporting today, yesterday, last week. And what they're saying is actually the consumer still looks reasonably robust at this point, which means probably there's still legs in this cycle, that we may have still further to go. Yes, the Fed is tightening. Yes, there are a whole bunch of factors that are going to slow things down. Obviously, inflation is going to be one of them. But nevertheless, what are we taking away from this earnings season thus far as to the health of the U.S. consumer, the major driver of the U.S. economy?
Well, I think the takeaway so far is that the U.S. consumer is in pretty good shape. I'm glad you brought up GE because I don't think GE is necessarily a representative example for the broader market. Instead, I think you want to look at stocks in the industrial sector that are leading indicators of potential growth ahead, like a J.B. Hunt or a UPS or a transportation stock, which is pretty consistently a better leading indicator of growth. Those stocks are telling you that growth conditions are actually pretty stable. They're still seeing pretty strong end market demand. And if we can get some easing in input cost pressure via oil prices, demand growth is probably largely intact. I think for the consumer space, we have yet to get to really a wide swath of retail sector earnings. We'll get to that in a couple of weeks. But in general, the consumer is in pretty good shape as well. Your better leading indicators there right now are the economic data. As you spoke to already this morning, consumer confidence levels are actually holding in there. I would argue that the reason consumer confidence is finally stabilizing is probably because the consumer is finally seeing some reprieve to inflationary conditions around the corner. If we can continue to see oil prices come in and gas prices moderate a little bit, that can go a long way to making the consumer feel a little bit better. We've got to see food prices come down a bit. But in general, I think the consumer is hanging in there, still stable. But as interest rates rise, you're going to see housing reflect some slowdown. You're going to see auto sales likely hit the skids to some degree. So you are going to see weakness emerge in broader, longer dated demand, kind of interest rate sensitive groups in the consumer space. You need to see consumers go out and spend more on services, go out to restaurants, go out to theaters, start to actually interact in the economy to make up for that demand shortfall. So far, we're starting to see that. Will it continue into the summer months? We'll have to hear the companies report in on that in the next couple of weeks, but generally, so far, so good.
Okay, we're going to wrap things up there. Fantastic conversation. Right in the middle of earnings season, as they say. We're probably going to get more of a consumer feel over the next couple of weeks. Today, really about big tech. We're going to talk about that later on in the program as well, get you fully updated as to what you need to know. Cameron Dawson, Fieldpoint Private Chief Market Strategist, thank you very much indeed. And as ever, our thanks to Bloomberg's Gina Martin Adams. Okay, what are we going to do next? We're going to talk Tesla. That story ain't gone away just yet. We need to talk about Tesla shares falling, dropping as much as 7.9%. It's the biggest move intraday in 2 months. Obviously, it comes back to the question of Twitter and what happens with Elon Musk and how he pays for that huge acquisition. They all fit together. It's interesting as well, Ford starting to make its first electric F-150s today. That's a huge story around that Tesla narrative as well. All of that coming up. This is Bloomberg.
Earnings season is here.
A moment of multiple crises.
Bloomberg is fastest with the numbers and analysis.
You do have some good news and bad news.
It's a good time to own volatility.
Bloomberg, the fastest numbers and analysis you trust.
It will be one of the biggest leverage buyout deals in history. Elon Musk has clinched the deal to buy Twitter for about $44 billion, but there are still questions about where Musk will come up with his share of the money and what changes he has in mind exactly. Joining us now is Bloomberg's Ed Ludlow in San Francisco. All right, Ed, let's first start off with the $21 billion question.
Sure.
How does Elon Musk come up with that number?
Yeah, there's certainly options. I mean, now that the board has unanimously accepted the bid, we move from it being sort of a hostile takeover to a friendly takeover, and one option is that private equity comes in, and we could see potentially names that weren't in the hat before, or maybe Thoma Bravo or Apollo come back in. The other is the role of Elon Musk's net wealth, right? We joke that he is the world's richest man, but cash poor. He has around $3 billion of cash and cash equivalents, although a fantastic piece on the Bloomberg today that explains we don't have full visibility into his private wealth, right? Some of his investments in his portfolio might have done better than we know. He could be more cash rich than we know, and so he could front up the cash. But more likely, you look at the role of Tesla stock, not necessarily that he'd sell it down, but it could be collateralized, just as it is in the margin loan portion of the debt financing. He could borrow against those holdings quite comfortably, as he's done for many years, and come up with the cash that way.
Ed, we're going to get earnings in a few days, and I'm curious to come to another number, which is the 54. How do we get there? Are the earnings going to justify that number? I'm really fascinated as to ultimately how we came up with this figure and how we know that that is what Twitter is really worth.
Yeah, I mean, sources tell me that during a town hall last night in San Francisco, Brett Taylor, the company's chairman, stood up and virtually said to all the attendees that the board had carried out their fiduciary duty, that this was the best deal for the company, that it was the best deal for shareholders. $54.20, there's question marks around that, right? You know, the company priced its IPO at around $25 a share. The first day of trading back in October 2013 was $45 a share. If you look at it from that standpoint, you've got compounded annual growth of just 2%. Or in other words, if you bought shares on Twitter's debut trading day back in 2013, you've made $9 a share on your investment, which doesn't seem like much. And a year ago, you know, April to August of 2021, the shares traded between $70, $75 a share. I think the big question is, where was the growth going to come from on the top line? Where was the growth going to come from on the bottom line? Twitter hasn't monetized through advertising as well as the street expected it to or hoped it would.
Well, and obviously there's going to need to be people in charge who then drive the growth strategy going forward. Right. Do we have any indication of who Elon Musk might want to put in those seats? Is Jack Dorsey one of them potentially?
Yeah, look, there's a lot of theory-driven stuff out there that Jack Dorsey comes back. You know, there were a lot of tweets that he put out overnight saying that he has had concerns for the platform for some time. You know, I'm just going to read the quotes. Taking it back from Wall Street is the correct first step was one of the things he said in his tweets, and he was basically saying he'd been concerned about the platform being a publicly traded company. Elon is the singular solution I trust, quote. You know, this is Jack Dorsey. So
buttering him up, Ed.
Twitter, right, and Twitter insiders that I've spoken to, after what's going to happen to their own jobs and their own equity compensation, you know, this is what the employees want to know about. The next big question is, well, what happens to hierarchy? Parag Agrawal, the current CEO, was quoted in the statement. He gave the town hall last night, and then Jack Dorsey backed him in a tweet last night. So it seems as if he will remain as CEO for the time being, but we just don't know. Does Elon Musk walk into the office in Market Street one day and say, hey, I've arrived, I now run this place? We just simply don't know.
Yeah, I'm still slightly kind of figuring out the whole kind of cash poor thing when it comes to Elon Musk. But hey, yeah, it's a relative trade. Ed, great stuff. Thank you very much indeed. Bloomberg's Ed Ludlow joining us from San Francisco. Let's kind of pivot now and focus more on what's happening with Tesla, because the challenge gets greater. The electric vehicle maker, of course, has many rivals, but it gets a really big one today. Ford is starting to build its first all-electric F-150, the F-150 Lightning pickup truck. It's doing so in Michigan. This is a high-volume vehicle that represents a major challenge. We don't even know when we're going to get the Cybertruck from Elon Musk. Feels like a distant prospect at the moment. Let's talk about this now. Bloomberg's Craig Trudell joins us here in London. Craig, let's talk about what is going on in Michigan today and how big a challenge ultimately this represents for Elon Musk.
Yeah, this is the Rouge Electric Vehicle Center. It's adjacent to or sort of on the same grounds where for years the Rouge is sort of synonymous with scale and mass manufacturing. Henry Ford, obviously the history of the assembly line. This is where they're going to be producing this truck. They've already increased production capacity for it twice before it's even in production, just based off of the really strong demand that they've seen. It's a really big deal. It's hard to sort of overstate just how massive the F-Series pickup line is in terms of a franchise for Ford. And that's because of the number that they make, the amount of money that comes in with each one of those pickups. We're talking $50,000-$60,000, and in some cases much more than that. So this is a case where they are really putting one of their sort of crown jewels at stake, and the early sort of indications are that customers are really receptive to it.
Okay, so Ford is already getting there, Craig. As Guy alluded to, the Cybertruck of Tesla is not yet there. We know that Tesla has a first mover advantage in the EV market as a whole, but can they really compete on this if they're that far behind in this segment particularly?
Yeah, I think it's entirely possible that, the Cybertruck ends up being sort of like the Model S and Model X, kind of a smaller volume, vehicle in the stable, which is fine, I guess, if Tesla is sort of, prioritizing profitability. They've clearly been executing extremely well with, just two, big volume models. But if this is a company that is really serious about, doing 20 million units a year, they're really going to want to take, a big chunk of the pickup segment in the U.S. That is the biggest segment and has long been so. The F-Series has been the top selling model line in the U.S. for 40 years running. GM sells an awful lot of Chevy Silverados and GMC Sierras. Stellantis has the Ram pickup brand, and they interestingly made a little bit of noise today as well. We talk about the F-150 Lightning.
Yeah.
They alluded to stealing some thunder and hinted at an electric pickup that they have on the way as well.
All right, Craig, got to leave it there. Bloomberg's Craig Trudell, thank you so much. And of course, later today, we'll have more on that F-150 launch with Ford President and CEO Jim Farley, 2:30 p.m. here in New York. This is Bloomberg. Stocks are down with earnings from big business in focus, but there's a small business boom in the Midwest we're going to talk about next. What concerns for the future? Huntington Bancshares CEO Stephen Steinour joins us. This is Bloomberg.
This is Bloomberg.
We are an hour into the U.S. trading session. It's looking pretty ugly out there. Bloomberg's Ritika Gupta is tracking the moves. Ritika, we're right around session lows at this point.
Yes, Kaylee, you're right. The moves are getting a little bit more aggressive, with that selling the S&P 500 down some 1.5%. The NASDAQ 100 underperforming, down more than 2%. There is a defensive tone to this market. Take a look at the industrial sector, down 1% or so. GE earnings weighing on this index. Concerns about inflation, concerns about supply chain issues, and of course the tech sector down in a big way too, just ahead of those earnings. Now tech really has not been helped out, despite the fact that we've had those yields falling in a dramatic fashion. If you look at that 10-year yield over the past 5 days, down some 20 or 18 basis points right now. It's concerns about the China slowdown in demand, those aggressive rate hikes by the Fed. That has investors flocking to those safe havens like treasuries. But tech really has not acted like a safe haven this year. As you can see with some of those mega cap names, those shares down in some of the double digits on a year-to-date basis. Those 5 big mega cap names reporting this week as well have lost about $880 billion worth of market cap in this month alone. So they have a lot to prove to investors in these upcoming earnings, which do kick off in earnest with Microsoft today. A lot of focus about the cloud computing products, the Azure, and of course Alphabet, looking at those Twitter's YouTube ad revenues. Then we have Meta tomorrow, and then on Thursday we have Apple and Amazon. So Katie, will they sizzle like a Tesla or will they tank like a Netflix?
There's a lot to be fought over the next day or so when it comes to this tech sector. Ruki Gupta, thank you very much indeed. That's the mega cap sector. Let's talk about what is happening a little further down the cap scale. Small business owners say that it's getting pretty rough out there. Yesterday, we spoke to Joe Wall, National Director of the 10,000 Small Businesses Voices program at Goldman Sachs, to discuss his latest survey of those businesses.
What we found on inflation is that 88% of small business owners say inflationary pressures on their business has intensified. What we found on workforce is 88% say it's either worse or the same, and on supply chain, 80% say it's worse or the same. So, the cumulative impact of that has really painted a picture that, that's indicating that the economic conditions for the small business community have gone from bad to worse just in the last 3 months.
Joe Wall talking to us yesterday. Let's talk more about this. We're joined by Bloomberg's Sonali Basak and Steve Steinour, Chairman and CEO at Huntington Bancshares. Huntington is one of the top lenders to small businesses in the United States. Steve, Goldman Sachs, that survey of small businesses talking about things going from bad to worse. Is that what you see?
Well, there's no doubt a challenge in both labor supply, now cost of labor with inflation, and supply chain. That's been with us for years, and it has gotten worse. On the other hand, small businesses are doing very, very well. This has been an extraordinary run-up over the last several years as we've worked our way through pandemics, as these businesses have. And as we're out talking with our customers, certainly these challenges are present. But they're optimistic. They've got pipeline, they've got orders, they've got activities that they just have to figure out how to fulfill and overcome the existing challenges. Many of them are able to pass along the inflationary costs that they're experiencing, and that's a good thing for us in the short term. It's obviously a longer term structural risk, but businesses are doing well.
I think the question here, Steve, too, is how long can that last for in terms of passing on those costs to consumers? When we talk to bankers across the industry, they really do say the consumer is strong, but these inflationary pressures are here to last for a while longer. So what's the breaking point?
Well, it's not clear how long they're here. So, for example, price at the pump has radically changed just in the last 6 weeks or so with the unfortunate and tragic Ukraine situation. Now, that can reverse itself over time with increased production out of the Middle East and certainly U.S. and other sources, Venezuela, discussions going on there. So there are a variety of potential relief valves for that. The consumer fundamentally is in strong shape, as are many of the small businesses. There's a resiliency. Particularly here in the Midwest, we see a lot of our customers working hard every day to get through the challenges and, frankly, to deliver great results. And they're able to do that sometimes with our support.
Well, obviously, Steve, because the consumer has been looking good, because the U.S. economy has proved resilient, the Federal Reserve also thinks that it can be aggressive in tightening monetary policy, and we understand it plans to do so. How will that directly impact your business when, in theory, higher rates, yes, should help on the net interest income side, but also at a certain point can crimp demand for loans?
Well, the key is this Fed's goal of a soft landing. So if we're able to get these rate increases passed through slow inflation and significantly reduce it and get to a soft landing, that's a great outcome for everyone. We don't want to live with structural inflation year in, year out, and we don't need to. I mean, there are alternatives for the Fed to take an even more stronger position on rates if they had to. Fortunately, at this point, as we're hearing from the Federal Reserve chairman and others, they believe they can contain inflation, and we're optimistic about that as well.
You know, one of the places we see inflation is in rental prices, is in home prices, and is in real estate prices. You have about 1,000 branches across 11 states. We've seen branch networks really shrink in the last couple of years across the major banks. So what is your plan here for your real estate footprint moving forward? Are you willing to add more for the sake of expansion, or are you looking for ways to do this in a way that's more cost effective?
Well, we add a certain amount of branches every year, but we also do consolidations. We'll continue to do that as we move forward, repositioning our physical distribution. We invest a lot in digital, as many businesses do, and I believe that will be one of the pathways to our future success. having 7x24 convenience digitally for our business customers as well as consumers so that we can help them when they are seeking to do business with us. I'm optimistic about the real estate markets generally. You started with housing. There is a lack of housing supply, and that's in many, many markets. Certainly in our primary markets, that's the case. There's just not enough construction labor or construction materials to support the demand going on. So we're in a supply-constrained recovery. We've been that way with supply chain issues and with labor issues now for a couple of years. Generally, that should mean the economy, the underlying strength of the economy will propel us forward for quite a while.
Are you supply constrained, Steve? What are you seeing in terms of wages? What are you seeing in terms of compensation? Inflation is running hot. Are wages running hotter?
Inflation is hot at the moment. It's been with us now for a year or so at a higher level. We have responded with increasing compensation programs, including benefits, over the last year and a half. So we'll likely have to continue that or choose to continue that over the next year as inflation starts to abate. But we also have other levers. We're in a workplace flex mode now, so some of our fixed costs in terms of real estate will be reduced as we lower the fixed costs in the company, potentially offsetting that in part with compensation.
Okay, Steve, so that's the wage equation for you specifically at Huntington Bancshares. What about for the small businesses you deal with? Are they also facing those wage pressures, and does that mean they have less capital to spend on other things?
Well, there's clearly wage pressure, I think, across the spectrum, as well as labor shortage. The consequence of that is all the businesses are feeling that they've got to increase wages, and many are doing that. Most are doing that, but they're also passing it along. The consumer's in great shape, as we mentioned a minute ago, and so are most of the businesses. And so there's this pass-through that's going on that is helping small businesses and others get through this period of inflation in the economy.
You know, speaking of inflation here, also this idea that we're still in a place that's not on a down ramp yet. You know, there's the idea of a recession around the corner, but not immediately. So in the near term, are you finding, and you yourself have just done an acquisition for a mid-sized investment banking firm, are you seeing that people are looking to bulk up for scale to prepare for the times ahead?
Well, many businesses have scale as an element to their equation, and that would certainly be true with us. And so we just announced an acquisition of Capstone Partners, a great middle market investment bank located in Denver and Boston, and that will be additional services we'll be able to offer to our customers. We have 500,000 or so small, medium-sized businesses that we do business with every day, and as generations change and transitions need to occur, having that trusted advisor will be an important offering that we'll be able to provide to our customers. So this is a really important deal. It's got synergies on multiple levels for us as well. But I think it fundamentally will bring Main Street banking with bank M&A advisory to these Main Street customers, which generally get overlooked.
Yeah, even the biggest Wall Street firms, Goldman Sachs, Bank of America, for years has been bulking up on talent and investment banking in the middle market here. And I'm wondering, you know, there's been such a long complaint, Steve, for such a long time that the Amazons of the world just got money quicker, that we're able to access financial services faster. And do you see a tipping point here for mid-size and smaller companies for them to be able to raise capital and merge at a better scale?
I do. I think that is imminent. It's already starting to happen on some basis, and we'll play a role in that for our customers and perhaps others as we go forward with this great opportunity with Capstone Partners.
Steve, Shivani talks about kind of what comes ahead. Does a recession come? Is a recession a near-term prospect, a medium-term prospect? How much more do you see in this cycle? I have to say, I've listened to what you said during this interview, and you sound pretty positive on the businesses you serve and the consumers that you serve.
Well, I'm positive for a number of reasons. There's a reshoring of manufacturing, and that will benefit the Midwest, our primary markets. There's a significant amount of stimulus spending that is yet to be invested. Think about roads, bridges, and others. the local governments, state, county governments are all flush with stimulus funding and looking at making strategic investments. So you have a lot of pump priming yet to occur on both of these fronts, and we're in a wonderful position to support and be part of that. And then locally, we're a Columbus-based headquartered bank, Columbus and Detroit, and both these markets are doing well. Columbus just announced a very significant Intel investment, and as that investment goes forward, the suppliers that support the chip manufacturing will also relocate here. This is going to be a big deal. This is like a century ago, Ford opening up in Detroit. This will be a major moment for Silicon Heartland, and it won't just be Columbus. It'll be parts of Ohio and the Midwest generally.
Well, with that said, too, you mentioned Intel and investment. What about the U.S. government here, Steve? Do you see more need for more investment in cities across the country, cities that you operate in, as some of the stimulus starts to wear off?
I don't think we need more stimulus funding at this point. We need to invest what's already committed wisely and make changes, real changes in the cities, including the neighborhoods of need as we go forward. And I think you'll find the business community aligned with broader objectives in that regard and opportunities for all as part of what we're going to try and stimulate around all of our markets.
All right. On that note, we will leave it. Thank you so much to Steve Steinour, Chairman and CEO of Huntington Bancshares, and as well, thank you to Bloomberg's Sonali Basak. We did have some breaking news crossing the Bloomberg terminal. We wanted to mention there is a report out that says that Russia has halted natural gas supplies to Poland. This is according to a report. You are starting to see a big reaction in the FX markets, in particular. The Polish zloty weaker on the day at its weakest levels of the session against both the U.S. dollar and the euro. Right now, euro zloty trading at 4.6951 or so, weaker by more than a full percentage point. So we will continue to monitor that story. Russia again said to have halted gas supplies to Poland. Now coming up, we're going to turn to regulation. SEC Chair Gary Gensler floats an idea aimed at making the bond market more transparent. We'll have those details next. This is Bloomberg.
now.
Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. Russia's Foreign Minister Sergei Lavrov warns that there is a serious danger of nuclear conflict. Lavrov told Russian TV the risk cannot be underestimated. He also said that peace talks with Ukraine's negotiating team would continue, even though many in Russia believe that Ukraine's position is set by the US and other Western countries. The Biden administration wants to widen access to Pfizer's promising COVID therapy pill. Starting this week, tens of thousands of pharmacies will be able to order the pill, and the administration will launch more sites where people can be tested, examined, and get pills in just one stop. The pill must be taken within 5 days of the onset of symptoms. And Securities and Exchange Commission Chair Gary Gensler has floated an idea aimed at increasing transparency in fixed income markets. He wants to slash the amount of time that traders have to report many bond transactions from 15 minutes to 1 minute. Gensler says the disclosures have generally failed to keep up with technology. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg. Kaylee.
All right, let's get more on that SEC bond market story and bring in Bloomberg's Ben Bain, who covers the SEC for us down in Washington. All right, Ben, why is Gary Gensler calling for this? What's his argument?
Yeah, so basically what the SEC chair is saying is that as technologies improved drastically, as trades now happen in fractions of seconds, and really the rules around reporting these transactions in what he says is really the $50 trillion fixed income market globally have not really kept pace. Currently, trades must be reported within 15 minutes to a system called TRACE, which FINRA, industry-backed regulator, runs here. And what he's saying is basically there's no reason that maybe regulators shouldn't look at trimming that down to a maximum of 1 minute. He's basically saying that the quicker information is reported and disseminated and made public, he sees a benefit to the market overall. He effectively is saying that the rules have not changed, even as these markets have changed very significantly with the advent of new technologies.
What would this mean for the industry? What is the industry's response to this? How much would it cost the industry to do this?
Well, it's a great question. I mean, any rule change down here in Washington is always going to involve a cost-benefit analysis. Basically, a regulator is going to have to deal with a lot of push from many sides in terms of coming out with something that the industry is going to ultimately have to abide by, but also they're going to have to justify why this would be a good idea. This isn't a new idea in the sense that regulators have been touching on this, which has ultimately been a very hot-button issue here for some time. Going back to the Trump era, there was a proposal that was floated that would have effectively increased rather than decreased from 15 minutes to 2 days the length of time that corporate block trades can be reported, and that generated a lot of pushback from certain parts of the investment community, while others actually thought this was a great idea, who basically said that 15 minutes is such a short window that it doesn't allow big investment firms to make these large transactions.
To that point, Ben, if 15 minutes was a short window, 1 minute is just no time at all. I mean, how practical is this? How could it practically impact trading?
We heard from one analyst today, and effectively, this would be a massive change, and it's going to take some time. So even if FINRA and the SEC tried to implement this, this could take years to actually put in place. The reporting mechanisms, how markets are timed, reporting is a big part of that because there's a lot that essentially would have to change in the background. We're already talking about the weeds here. We're already talking about the plumbing of Wall Street. But in order to adjust one little pipe and how quickly that information is disseminated, it would be a big lift, is essentially what we're hearing so far. If this goes forward, we can definitely expect to hear a lot of pushback, I'm sure, from some who think 15 minutes is maybe too short already.
Okay, watch this space. Ben, great reporting. Thanks very much indeed. Bloomberg's Ben Bain joining us from DC. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. The world's second largest container line expects the strong ocean shipping market to continue this quarter. Maersk raised its outlook for full-year profit after reporting a strong January to March period. Shippers are thriving financially as supply chain turmoil exhausts the capacity that keeps commerce flowing. UBS leaned on traders at its investment bank to post better than expected profit in the first quarter. Volatility caused by Russia's invasion of Ukraine helped drive revenue at the trading unit to a record. Meanwhile, the Swiss bank's wealth management business was hurt by slowing client activity and rising costs. Fidelity is bringing crypto to its workplace retirement plans. The firm will have a product ready in coming months to allow 401k plan participants to direct a portion of their savings into Bitcoin. Employers will choose what percentage of an employee's account can be directed into crypto, up to a cap of 20%. And that is your latest Business Flash. Kaylee, Guy.
Ritika, thank you. Guy, I think this is such a fascinating and kind of big deal in the crypto space in particular, because obviously Fidelity isn't saying here that you can put your entire 401k portfolio into digital assets. There is a cap on it, but just the ability to do so would be quite a development. I do wonder, though, the audience for this probably going to skew toward the younger side, those not as close to retirement, considering this is still a very, very risky asset class.
Potentially, though, that's a huge amount of money. But this flies in the face of what the Department of Labor has been saying.
Yeah.
It has been making it very clear that it thinks that this kind of thing is a bad idea. So it's interesting that Fidelity is taking a very different tack here, Kaylee.
Yeah, they said, what, just about a month ago, they threw cold water on this idea, essentially saying it's too volatile, it's too risky, that employers offering crypto in their plans should exercise extreme care before considering this. So this definitely is probably going to be an evolving conversation, and it's also a conversation we will be having later on today, Guy, 1 p.m. Eastern Time, Bloomberg Crypto, 1 p.m. here in New York. We'll be talking with the CEO of Ripple as well. So it's going to be a really great show. We'll talk about 401ks and a lot else. Shameless plug, Guy.
Absolutely. Always. What else have we got coming up? Here's my shameless plug. The European close is coming up next. What are we going to be doing on that? We need to talk about some of these market moves that we're seeing today. We are seeing certainly a significant sell-off evolving in US stocks, which is now rippling back to continue that theme into European stocks. We're now down by 0.4%. The euro is trading well below 107 now, 106.49. You've also got this weakness now in the zloty as well. You've got this report from a Polish portal suggesting that Russia has halted gas supplies to Poland. The stock market there down as well. We're checking on this one very carefully. Anyway, Laura Cooper is going to be joining us next, BlackRock Senior Macro Investment Strategist. That conversation is coming up. The European close up next. This is Bloomberg.
About that all day yesterday.
Tuesday, April the 26th, US stocks are starting to be really crushed right now. European stocks beginning to follow. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So half an hour to go to the European close. Let's check the price action. The bears are definitely in charge when it comes to stocks, certainly in the United States, increasingly here in Europe. The 600 now down by 0.5%, trading at 442. We're down by around 2 points. The CAC 40 is where the volume is today, so that's interesting. Elsewhere, actually, volume is relatively light. Euro dollar, keep an eye on what is happening here, 106.48. Big relationship, obviously, into China. The Chinese currency under significant pressure. What's going to happen there next could influence what happens here in this pair as well. 106.48. I was listening to a currency strategist earlier on talking about the fact you want to watch out for the 103 area, not much below that in terms of positioning. Then let's talk about what's happening with Euro Zloty, up by around 0.9%, or down 0.9%. There is a report from a Polish portal suggesting that maybe Russian gas has been cut off. The WIG's under a little bit of pressure as well. We're working, definitely, Kaylee, to confirm that story.
Absolutely. We'll continue to monitor all of those headlines, just as we will continue to monitor these markets, Guy. It's really, really ugly here in the U.S. when it comes to equities, and the question really is why. You did have a number of companies out this morning warning of inflationary headwinds, the likes of GE saying profits going to be on the lower end of the forecast as a result. So maybe that sentiment is really what is weighing on risk appetite ahead of results from mega cap companies like Alphabet and Microsoft after the bell today. Ahead of those results, Ro, the NASDAQ 100 is down nearly 3 full percentage points, down about 2.9% at this point, even though we're seeing bond yields coming in really quite dramatically. The 10-year yield is down about 9 basis points to 273. The 2-year yield, the front end, down 9 basis points as well. 253 is where we trade. And then, of course, I just wanted to point out oil as well, because we're back above $100 a barrel on WTI, trading up about 1.6%. So interesting dynamics here when it comes to the growth and inflation picture and how all of this is filtering through earnings and through these equity markets. Guy.
Absolutely. I think that oil story is fascinating. Let's talk about some of the earnings we're getting here, because we've been trying to ask this question, or answer this question today, talking about whether or not actually the macro matters more than the earnings. The consensus thus far